The structural advantage of real estate investment is defined by a unique tax asymmetry. It is the only major asset class where an investor can generate consistent cash flow and asset appreciation while simultaneously reporting a paper loss to the Internal Revenue Service. This phenomenon was codified on July 4, 2025 through PL 11921, the One Big Beautiful Bill Act, OBBBA, which permanently reinstated 100% bonus depreciation for qualifying property. Unlike previous temporary incentives, this legislation creates a durable feature in the U.S. tax code, forcing institutional capital to reorient acquisition timelines around tax logic rather than just yield. This shift occurs amidst an $84 trillion intergenerational wealth transfer where capital is increasingly parked in LLCs and partnerships to exploit the fact that unlike a bond portfolio or an S&P 500 ETF, real property is structurally privileged. The competitive moat in this sector is derived from legal and forensic complexity rather than physical scarcity. Maximizing after-tax returns requires a cost segregation study, a process where licensed engineers physically disaggregate a building's components into specific IRS asset classes. This is an engineering exercise costing between $5,000 and $15,000. The knowledge asymmetry between those who treat depreciation as a footnote and those who employ forensic analysis creates a tiered market. By correctly engineering the tax architecture around an asset, an investor can transform a standard 6% cap rate property into an 8 to 9% after-tax cash machine during the initial years of ownership. This architecture allows the investor to maintain a significant edge over unsophisticated buyers who lack the infrastructure to execute these advanced tax strategies. Net operating income, or NOI, remains the primary metric for property performance because depreciation operates entirely below the NOI line. This separation allows a property to generate $200,000 in actual cash while the owner reports zero taxable income. Under standard MACRS, or Modified Accelerated Cost Recovery System, residential property depreciates over 27.5 years and commercial over 39 years. For a $3 million commercial building, straight-line depreciation offers a modest $76,900 annual deduction. However, cost segregation reclassifies components like specialty electrical, HVAC, and cabinetry into 5, 7, and 15-year classes. Under the OBBBA, these shorter-lived assets qualify for 100% bonus depreciation in year one. If a study identifies 20% of that $3 million building as short-lived property, the first-year deduction jumps from $76,900 to over $710,000, a nine-fold acceleration that completely eliminates taxable income and creates suspended losses for future use. This tax shield fundamentally alters the required cap rate for target returns. A 6% cap rate investment at a 37% marginal tax rate typically yields only 3.8% after tax. With cost segregation, that same 6% cap rate behaves like a 6% after-tax return in year one, representing a 57% improvement in yield. Leverage further amplifies this effect non-linearly. In real estate, depreciation is calculated on the total purchase price, not just the equity. A $1 million equity stake in a $5 million property allows the investor to claim 100% of the depreciation on the full $5 million value. Essentially, the lender funds the asset, but the equity investor claims the tax deduction. However, investors must maintain a debt service coverage ratio of at least 1.25x. The tax shield is a paper deduction and does not provide the liquid cash necessary to service debt if rental income falters.
A sophisticated tax strategy utilizes three distinct layers: straight-line MACRS for baseline deferral, cost segregation for immediate acceleration, and the Section 1031 exchange for perpetual deferral. The 1031 exchange allows an investor to roll equity into a replacement property, deferring both capital gains and depreciation recapture indefinitely. By chaining these exchanges, an investor operates a tax-deferred compounding machine. For high earners, the real estate professional status, REPS, is the ultimate override. It allows paper losses to offset W-2 income rather than just passive income. However, this requires rigorous documentation of material participation to survive IRS scrutiny. This pax elegans is often countered by structural friction. Real estate carries high transaction costs, often 5 to 10% of asset value, which must be cleared before the tax alpha becomes a net gain. Furthermore, maintenance capital expenditures, CapEx, can erode returns. An old HVAC or roof is a cash event that does not appear on trailing 12-month NOI. Additionally, investors in high-tax states like California or New York face non-conformity, where state-level taxes are applied to income that is sheltered at the federal level. The life cycle of this strategy typically hits a structural cliff between years 5 and 8, as segregated components are fully depreciated and taxable income rises. At this point, the investor must decide to either pay the tax or execute another 1031 exchange to reset the clock. The final verdict is that while the OBBBA provides a powerful shield, it is not a substitute for asset fundamentals. The tax architecture must sit on top of a sound investment. One should never let a depreciation deduction justify an acquisition that the underlying economics cannot support.